Currency concerns. The rupee's rapid stumble poses a fresh challenge for the economy. It has been a tumultuous time for the Indian rupee, even as the Reserve Bank of India (RBI) has been actively stepping into the foreign exchange market to stem its free fall in pursuit of what it calls an orderly exchange movement. The rupee had hit an all-time low of 85 to the US dollar on 19 December. Last Friday, it came precariously close to the 86 mark before a late intervention by the central bank pulled it back to 85.53. A confluence of factors at work have hurt the rupee in recent times, including the sustained outflows of foreign portfolio investments from security markets after key indices peaked in late September. Overstretched stock valuations are demotivating corporate performance in the July September quarter, and China's economic stimulus nudged emerging market portfolios from Mumbai to Beijing. The Donald Trump factor added a fresh headwind with the dollar strengthening since his US presidential electoral victory, and emerging market currencies were further rattled by his warning of a 100% tariff on BRICS nations for a common currency plan to challenge the dominance of the US dollar in global trade. Even before fears about Mr. Trump's generally protectionist stance on trade matters materialize, India's goods trade story is spurting. Record trade deficits and import bills are going to show up in his quarter's current account deficit, which is expected to double from around 1.2% of GDP in the second quarter. Services trade is still throwing up a surplus, but the uncertainty about the H-1B visa regime will be a key monitorable despite Mr. Trump's latest soothing comments on the system. The previous RBI governor, Saktikant Das, did well to fortnightly dismiss the BRICS currency as just an idea in the air and stressed that India has no de dollarization agenda. The government must also issue an unequivocal statement to this effect in public fora and in diplomatic parleys to put the issue to rest. It is true that the currencies of other emerging markets have taken a bigger hit, and a falling rupee bonds were well for exporters, but India also needs to worry about importing inflation, especially on elastic terms such as edible oil, crude petroleum. Moreover, foreign investment flows are uncertain, as is the US monetary policy outlook for 2025. There is also a limit to the extent the central bank can deploy forex reserves to manage the rupee's trajectory. And the finance ministry has considered that recent exchange rate movements cram the freedom for monetary policymakers. India's present economic woes are linked to domestic drivers such as faltering consumption and reluctant investments, with the rupee coming under pressure. The country's external resilience could be tested as well as in 2025, and policy makers must gear up to manage this new risk.